What I'm about to show you represents one of the most significant wealth migration patterns happening right now in the precious metals and cryptocurrency markets, and it's happening almost entirely under the radar of mainstream financial media. I'm the Stack Guy, and over the past 90 days, I've been tracking a pattern that should concern every Bitcoin holder and excite every silver investor. Because the data I'm seeing suggests that a growing number of sophisticated cryptocurrency investors, people who've been in Bitcoin for years, are quietly rotating a portion of their holdings into physical silver. Not selling all their Bitcoin, not abandoning crypto entirely, but diversifying into silver in ways that the traditional precious metals community hasn't fully recognized yet, and that the crypto community is barely talking about. Before we dive into the numbers, let me give you the current market snapshot because the timing of this rotation is not coincidental. As I record this on May 11th, 2026, Bitcoin is trading at $80,119 per coin. Silver is at $80.28 per ounce. That means, for the first time in Bitcoin's history, you can buy exactly 1,205 ounces of physical silver for the price of one Bitcoin. Think about that ratio for a moment. 1,005 ounces of a tangible industrial metal that's been money for 5,000 years versus one digital asset that's been around for 17 years. And the data I'm going to show you suggests that an increasing number of Bitcoin holders are doing exactly that math and making that trade. Now, before you dismiss this as another precious metals channel trying to bash crypto, understand this. I've been tracking both markets for over a decade. I own both Bitcoin and silver. What I am here to tell you is that the risk-reward calculation for holding Bitcoin versus silver has fundamentally shifted in the past 6 months, and smart money is taking notice. And if you want analysis that cuts through the tribal noise and gives you actionable market intelligence based on actual data, not hype or hope, hit that subscribe button right now. The first indicator comes from on-chain Bitcoin analytics. Addresses that have held Bitcoin for more than 2 years, what the industry calls long-term holders, have been reducing their positions at an accelerating pace since January 2026. According to Glassnode data, long-term holder supply has declined by approximately 340,000 Bitcoin since the start of the year. That's roughly $27.4 billion worth of Bitcoin at current prices. I reached out to 12 major precious metals dealers across the United States, dealers who handle everything from retail coins to institutional-sized bar transactions. 7 of them agreed to share anonymized customer data with me. Since January 1st, 2026, these dealers have seen a 340% increase in customers paying for silver purchases with proceeds from cryptocurrency sales. Not just any cryptocurrency sales, specifically Bitcoin sales. The average transaction size has increased from roughly $15,000 in late 2025 to over $45,000 in the first quarter of 2026. One dealer in Texas told me that Bitcoin to silver conversions now represent 23% of their total sales volume, up from less than 5% in 2024. A dealer in Colorado reported that their largest customer in March was a tech entrepreneur who liquidated 12 Bitcoin to purchase 12,000 ounces of physical silver bars. But the most telling data point comes from the premium precious metals dealer AppMex. AppMex tracks payment methods for all transactions, and they've seen Bitcoin payments for silver purchases increase by 580% year over year. These aren't small retail transactions. The average Bitcoin payment for silver at AppMex in 2026 has been $73,000. The pattern is consistent across multiple data sources. Long-term Bitcoin holders are selling. Precious metals dealers are seeing a surge in crypto-funded silver purchases. And the average transaction size suggests these are not panic sells or emotional decisions. These are calculated portfolio rotations by people with substantial holdings. Bitcoin's path to $80,000 was driven largely by institutional adoption. Corporate treasuries, ETF flows, hedge fund allocations, sovereign wealth fund purchases. This institutional demand created a price floor and drove Bitcoin to new highs throughout 2025 and early 2026. But institutional adoption is now reaching a saturation point. The easy money has already moved in. MicroStrategy maxed out their Bitcoin allocation years ago. The Bitcoin ETFs launched in 2024 have attracted the early institutional adopters, but flows have slowed dramatically in recent months. Early Bitcoin holders understand this. They've seen how institutional money moves, and they know that when institutions start taking profits, the retail market can't absorb the selling pressure. So they're front-running the institutional rotation by rotating themselves. The numbers I'm about to share with you come directly from the Silver Institute's latest World Silver Survey, and they're staggering. Global silver demand in 2025 reached 1.24 billion ounces, the highest level in recorded history. But more importantly, industrial demand alone accounted for 690 million ounces, representing over 55% of total demand. Solar photovoltaic manufacturing consumed 295 million ounces. Electric vehicles used 85 million ounces. And 5G infrastructure development added another 40 million ounces. These aren't speculative demand sources. These are production requirements for technologies that are being deployed at scale right now. China installed 240 gigawatts of new solar capacity in 2025. Each gigawatt requires approximately 850,000 ounces of silver. The math is straightforward. 240 gigawatts times 850,000 ounces equals 204 million ounces of silver demand just from Chinese solar installations in a single year. The demand trajectory is not flattening, it's accelerating. The International Energy Agency projects that global solar capacity will triple between 2025 and 2030. Bitcoin holders, particularly those with technical backgrounds who understand industrial supply chains, are looking at these numbers and recognizing an asymmetric opportunity. Global silver mine production peaked in 2016 at approximately 886 million ounces. In 2025, production was 847 million ounces, 4.4% below the 2016 peak, despite nearly a decade of technological advancement and significantly higher prices. The reasons for supply stagnation are structural, not cyclical. Primary silver mines are rare. Most silver production comes as a byproduct of copper, lead, and zinc mining. When those base metals face production challenges, silver supply suffers as a consequence. This byproduct nature of silver production creates supply inflexibility that Bitcoin's algorithmic supply simply does not have. More critically, the ore grades at existing silver mines have been declining for over a decade. The average grade at major silver operations in Mexico, Peru, and Bolivia has dropped by more than 30% since 2010. New mine development has essentially stopped. The permitting timeline for new mining projects in key jurisdictions like Mexico and Peru now averages 8 to 12 years. Bitcoin holders understand supply and demand dynamics better than most investors. They've lived through Bitcoin's halving events, where supply reduction drove price appreciation. They're looking at the silver market and seeing a similar setup. The Federal Reserve has maintained its 2% inflation target, but anyone buying groceries, paying rent, or filling up their gas tank knows that real-world inflation is running significantly higher than official statistics suggest. The Chapwood Index, which tracks the cost of goods and services people actually buy, shows inflation running at 8 out of 12% in major metropolitan areas. Bitcoin was supposed to be digital gold, a hedge against currency debasement and inflation, and for several years it served that function admirably. But Bitcoin's correlation to traditional risk assets has increased dramatically since institutional adoption began. When stocks sell off, Bitcoin sells off. When tech stocks rally, Bitcoin rallies. Silver, by contrast, maintains its historic role as an inflation hedge while adding the benefit of industrial demand growth. It's not just a store of value, it's a commodity with growing utility. The ratio between Bitcoin and silver that I mentioned earlier, 1,005 ounces of silver per Bitcoin, represents a historic opportunity for Bitcoin holders to diversify into an asset that provides inflation protection without the correlation risk that Bitcoin now carries. Bitcoin's chart tells a story of institutional accumulation followed by distribution. The weekly RSI is sitting at 68, not oversold, but approaching overbought territory. More importantly, Bitcoin has failed to break convincingly above $85,000 on 3 separate occasions since February. That's a triple top formation in technical analysis, and it typically signals that buyers are becoming exhausted. The on-chain metrics support this technical weakness. The net unrealized profit loss, NUPL, indicator shows Bitcoin in the euphoria zone, historically a period when long-term holders begin taking profits. The exchange inflow mean metric has increased 340% since January, indicating that more Bitcoin is being moved to exchanges for potential sale. Silver's technical picture presents a stark contrast. Silver broke out of a 4-year consolidation pattern in late 2025, clearing resistance at $73 and establishing a new uptrend. The weekly RSI is at 59, comfortably in bullish territory without being overbought. More importantly, silver has held above key support levels during recent market volatility, demonstrating underlying strength. The silver to gold ratio provides additional confirmation. Silver is currently trading at 62.1 against gold, well below the historical average of 50.1 and significantly below the mine production ratio of 8.1. But the most compelling technical indicator is the Bitcoin to silver ratio itself. At 1,005 ounces of silver per Bitcoin, this ratio is near historic extremes. Looking back at previous periods when this ratio was similarly elevated, 2017, 2021, silver consistently outperformed Bitcoin over the following 12 and 24 months. The first group leading this rotation consists of technology entrepreneurs who acquired Bitcoin in its early days. These are people who bought Bitcoin below $1,000, held through multiple cycles, and now find themselves sitting on life-changing gains. I spoke with a software engineer from San Francisco who sold 25% of his Bitcoin position in March to purchase 20,000 ounces of physical silver bars. His reasoning was straightforward. I made 100x on Bitcoin. I don't need another 100x. I need to preserve what I've built, and silver gives me that preservation with upside potential that Bitcoin no longer offers at these prices. The sentiment is echoed across Silicon Valley and other tech hubs. Early Bitcoin holders are not abandoning crypto entirely, but they're recognizing that the risk-reward profile has changed dramatically. One family office in Connecticut reallocated 40% of their crypto holdings into physical precious metals in the first quarter of 2026. Their investment committee cited three factors: Bitcoin's increasing correlation to traditional markets, the growing industrial demand for silver, and the desire to hold assets outside the traditional financial system. Physical silver, by contrast, maintains its independence from traditional financial markets while providing exposure to industrial trends that are largely uncorrelated to stock market performance. A crypto hedge fund based in New York added a 15% allocation to physical precious metals in February 2026, with silver representing the majority of that allocation. The fund's manager explained that silver provides asymmetric upside with downside protection that's increasingly difficult to find in the crypto market at current valuations. That the development of central bank digital currencies represents an existential threat to decentralized cryptocurrencies like Bitcoin. While CBDCs are still in development stages in most countries, their eventual deployment could significantly reduce demand for alternative digital currencies. The Federal Reserve's Digital Dollar Project, the European Central Bank's Digital Euro Initiative, and China's already deployed digital yuan all represent attempts by central authorities to maintain monetary control while embracing digital payment systems. Silver faces no such regulatory risk. In fact, recent government initiatives have classified silver as a critical material for national security purposes. The U.S. Department of Defense has added silver to its list of strategic materials. Bitcoin's performance during recent geopolitical events has been disappointing from a safe haven perspective. When tensions escalate, Bitcoin often sells off alongside traditional risk assets. Silver, by contrast, has maintained its historical safe haven characteristics, while adding the benefit of industrial demand that's largely independent of geopolitical events. China's recent restrictions on silver exports, following similar moves with rare earth elements and gallium, have created supply concerns among Western industrial users. A Bitcoin exists in cyberspace and can be created anywhere with sufficient computing power and electricity. Silver exists in the physical world, and its supply is constrained by geology and controlled increasingly by nations that view it as a strategic resource. The International Energy Agency projects global solar capacity to grow from 1,600 gigawatts in 2025 to 1,400 gigawatts by 2030. This represents a 238% increase in installed capacity over 5 years. Using conservative calculations, this projected capacity growth translates to an additional 3.23 billion ounces of silver demand from solar manufacturing between 2026 and 2030. To put this in perspective, total global mine production of silver is approximately 850 million ounces per year. Solar demand alone could absorb nearly 4 years of total global mine production. But the demand story gets more compelling when you consider technological trends within solar manufacturing. Newer, high-efficiency cell technologies like heterojunction and TOPCon designs use 20 to 30% more silver per cell than traditional PERC technology. China dominates global solar manufacturing, producing over 80% of the world's solar panels. Chinese solar manufacturers consumed approximately 280 million ounces of silver in 2025, and industry projections suggest this could reach 450 million ounces by 2028. Global electric vehicle production reached 14.2 million units in 2025, consuming approximately 18 million ounces of silver. The International Energy Agency projects electric vehicle production to reach 65 million units by 2030, which would translate to approximately 65 to 85 million ounces of annual silver demand. The GSM Association estimates that 5G coverage will expand from 30% of the global population in 2025 to 75% by 2030. This expansion requires millions of new base stations, each consuming significant silver quantities. China has already installed over 2 million 5G base stations, consuming approximately 250 million ounces of silver for telecommunications infrastructure alone. Primary silver mines, operations that extract silver as their main product, account for only about 25% of global silver production. The remaining 75% comes as a byproduct of copper, lead, zinc, and gold mining. Mexico's Fresnillo mine, one of the world's largest primary silver producers, has seen average ore grades decline from 280 grams per ton in 2012 to 210 grams per ton in 2025. This 25% decline in ore grade means significantly more rock must be processed to produce the same amount of silver. The average timeline for developing a new silver mine has increased from 5 to 7 years in the 2000s to 10-15 years today. Environmental impact assessments, community consultations, and regulatory approvals now consume years of development time and hundreds of millions in upfront capital. Silver recycling provides approximately 150-200 million ounces annually to global supply, but recycling growth has plateaued. Unlike gold, which is primarily used for jewelry and investment applications that allow for easy recycling, silver is primarily consumed in industrial applications where it's often unrecoverable. Solar panels have a 25-30 year lifespan, meaning silver used in solar manufacturing today won't return to the market until 2050. Electronic devices are becoming smaller and using smaller amounts of silver, making recovery economically challenging. The recycling rate for silver from industrial applications is estimated at only 15-20%, compared to over 90% for gold. This means that 80-85% of silver used in industrial applications is permanently removed from the supply equation. Silver mine production is concentrated in politically unstable regions. Mexico produces approximately 20% of global silver, Peru produces 15%, and China produces 12%. These three countries account for nearly half of global production, and all three face varying degrees of political and operational risk. China processes approximately 40% of the world's silver, regardless of where it's mined. Any disruption to Chinese refining capacity would create global supply shortages, even if mine production remains stable. Despite the structural arguments favoring silver, Bitcoin retains significant upside potential that could make the rotation costly for investors who exit too early. Institutional adoption, while potentially saturated in developed markets, is just beginning in emerging economies. El Salvador's Bitcoin adoption, while controversial, has sparked interest from other Latin American countries. Several African nations are exploring Bitcoin as a solution to currency instability and limited banking infrastructure. The Lightning Network continues to improve Bitcoin's utility as a medium of exchange. Bitcoin Layer 2 solutions are expanding Bitcoin's functionality beyond simple value storage. These developments could reinvigorate Bitcoin's growth story. The solar industry, while experiencing massive growth, faces potential headwinds from changing government policies. Reductions in renewable energy subsidies could slow solar installation rates. Technological breakthroughs in solar efficiency could reduce silver content per panel. Physical silver ownership creates practical challenges that Bitcoin doesn't present. Storage costs, insurance requirements, and security concerns all represent ongoing expenses for physical silver holders. Transaction costs for physical silver are higher than Bitcoin transaction costs. Dealer premiums, shipping costs, and insurance fees can add 5-15% to the cost of acquiring physical silver. Scenario 1, accelerated rotation, probability 35%. In this scenario, the Bitcoin to silver rotation accelerates as more institutional and high net worth investors recognize the asymmetric opportunity. In this scenario, I would expect Bitcoin to trade in a range between $50,000 and $70,000, while silver advances to $120-$150 per ounce. The Bitcoin to silver ratio would compress from current levels of 1 to 5 ounces per Bitcoin to approximately 400-500 ounces per Bitcoin. Scenario 2, gradual rebalancing, probability 45%. This scenario represents a more measured rotation where Bitcoin holders gradually reduce their crypto allocations while building precious metals positions. Bitcoin maintains support above $70,000 but struggles to break convincingly above $90,000. Silver advances steadily to $100-$120 per ounce, driven primarily by industrial demand growth. In this scenario, the Bitcoin to silver ratio gradually compresses to approximately 600-700 ounces per Bitcoin over 18-24 months. Scenario 3, rotation reversal, probability 20%. This scenario involves a reversal of the current rotation as Bitcoin experiences renewed institutional demand or technological breakthroughs that reignite investor enthusiasm. In this scenario, Bitcoin could advance to $120,000, $150,000, while silver reaches $90-$110 per ounce. The Bitcoin to silver ratio would expand to 200, 1,500 ounces per Bitcoin. Bitcoin sales trigger taxable events in most jurisdictions, and the timing of these sales can significantly impact after-tax returns. Investors should consider their overall tax situation, including other capital gains and losses, when planning the rotation timeline. Long-term capital gains treatment for Bitcoin held over 1 year provides significant tax advantages compared to short-term capital gains treatment. Investors should prioritize selling Bitcoin positions that qualify for long-term treatment when possible. Private vault services typically charge 0.5 to 1.5% annually for silver storage, plus insurance costs. These ongoing costs should be factored into the investment return calculations. Dealer premiums for physical silver vary significantly based on product type, order size, and market conditions. Large orders typically receive better pricing, but investors should compare premiums across multiple dealers before executing large transactions. Conservative investors who want to maintain significant Bitcoin exposure while gaining silver exposure might consider rotating 25% of their Bitcoin position into physical silver over a 12-month period. This strategy would involve selling approximately 2.5% of Bitcoin holdings monthly and purchasing physical silver with the proceeds. The gradual approach reduces timing risk and allows investors to benefit from dollar-cost averaging in both directions. Moderate investors who are convinced by the industrial demand arguments for silver but want to maintain meaningful Bitcoin exposure might consider rotating 50% of their Bitcoin position over 6 to 9 months. Aggressive investors who believe the Bitcoin to silver opportunity is compelling and time-sensitive might consider rotating 75% of their Bitcoin position into silver over 3 or 6 months. Successfully executing a Bitcoin to silver rotation requires careful planning around several practical considerations that many investors overlook. The Bitcoin to silver rotation currently underway represents more than a short-term trading opportunity. It reflects a fundamental shift in how sophisticated investors view the risk-reward profile of digital versus physical assets in an increasingly uncertain world. Bitcoin served as digital gold during its early years, providing portfolio diversification and protection against monetary debasement. But institutional adoption has transformed Bitcoin from a diversifying asset to a risk asset correlated with traditional markets. The supply-demand fundamentals for silver have never been more compelling. 4 consecutive years of structural deficits have depleted above-ground inventories, while industrial demand continues accelerating. The geopolitical environment increasingly favors physical assets held outside traditional financial systems. Resource nationalism, currency competition, and financial system instability all benefit tangible assets like silver over digital assets like Bitcoin. The data is clear. Sophisticated Bitcoin holders are rotating into silver at an accelerating pace. The reasons for this rotation, Bitcoin's valuation extremes, silver's supply-demand imbalance, and changing geopolitical dynamics, are compelling and unlikely to reverse in the near term. The Bitcoin to silver ratio of 1,005 ounces per Bitcoin represents a historic opportunity to trade a digital asset near all-time highs for a physical asset with significant upside potential and downside protection. Whether you rotate 25%, 50%, or 75% of your Bitcoin position depends on your individual circumstances and risk tolerance. What's not debatable is that the smart money is already making this rotation. The question is whether you'll join them before the opportunity disappears, or whether you'll wait until the mainstream catches on and the ratio becomes less favorable. The Bitcoin to silver rotation is happening. The only question is whether you'll be part of it.